All right, y'all, today we're going to be going through a scalping strategy that you can use on the 5-minute time frame. Now make sure to watch this video to the end because I'm going to be giving you very specific information, not only how to find the trade setups, but also where to set your take profits and where to set your stop loss. If you don't do this correctly, you're not going to be profitable using the strategy. So make sure to watch to the end. Make sure to like the video and subscribe to the channel. All right, so let's get into it. This is a very simple 5-minute scalping strategy. It's a strategy that's really great for beginners because what it does is it basically gives you an algorithm. It gives you a system of things to look for and then exactly where to place your take profit and stop loss. So that even if you're not necessarily the best trader in the world, you can still be profitable over time using this strategy, especially while you learn, because I'm a big advocate of constantly learning, improving your trading. It's a never-ending journey. So here's what we're going to do. We are going to pull open the 5-minute time frame. And then what I'm going to do is I am going to use an indicator called Market Cipher B. And I'm going to go ahead and put 2 of these on my chart. Okay, I'm going to put 2 of these on my chart. And what I'm going to do is I'm going to come down and click the gear button. I'm going to turn off everything except for the money flow. So you're going to uncheck all these boxes, the RSIs as well. You can actually keep 0, 100%, OB 1 solid, OS 1 solid, trigger 1 and trigger 2. You can keep that on your chart, but uncheck everything else except for the money flow. And then go ahead and click OK. And then for the second market cipher, you're going to click the gear button and you are going to turn off the VWAP, you're going to turn off the money flow, and you are going to turn off the RSIs. And so basically what we're going to have is this, okay, where one market cipher B is only showing us the money flow, and the second market cipher B is showing us only the momentum waves, and then the blue dots and the purple dots, and I guess green dots and red dots that are buy and sell signals. Okay, so here's what we are going to do. It's very, very simple. Step number 1 is we are going to look for an anchor wave on Market Cipher B. So the first thing we are going to do when we are looking for a trade is we are going to look for an anchor wave on Market Cipher B. So what is an anchor wave? I define an anchor wave as any momentum wave that comes above the 60 line or comes below the -60 line. So when we're taking a look at Market Cipher B here, this is an oscillator and it oscillates above and below the 0 line. Okay, so this line right here is the 0 line, and anything below this will be negative numbers, and anything above this will be positive numbers. When we come above positive 60, that is considered overbought. And when we come below negative 60, that is considered oversold. So essentially, we're looking at the line right here, and you can see on the side it's telling you what the number is. So if you hover your mouse over here, it will actually tell you what the exact number is over on the right, and same below. You can see they're negative and positive numbers. So step number 1 is simply just identifying a wave that either comes above this 60 line or below this -60 line. Okay? So we don't even consider entering a trade using this strategy unless we see an anchor wave, okay? Now, when we see that anchor wave, then what do? We simply take note of it and say, there's the potential here that soon I will be entering into a trade. So the second thing we look for after we see that anchor wave is we look for a trigger wave, okay? What is a trigger wave? A trigger wave is any wave after that anchor wave has printed that is consecutively higher if it's on the negative side or consecutively lower if it's on the positive side. So basically, just to give you some examples of trigger waves, if we have an anchor wave, for example, right down here, we have clearly an anchor wave that has printed below that -60 line. This right here would be considered a trigger wave. Why would that be considered a trigger wave? Because it is higher than the anchor wave coming up, and it is now below that, or I should say above that -60 line. This would also be considered a trigger wave right here. And this would also be considered a trigger wave right here. This would also be considered a trigger wave right here. Now, It's very important that we understand that the oscillator will oscillate from below to above. So once we start printing trigger waves on the upside, we stop looking for trigger waves on the downside, right? So essentially, you could even say that once we printed this wave right here, this trigger wave, because we came up and we printed an anchor wave with a red dot. Once we print this trigger wave with a red dot, I would recommend you consider that you stop looking for trigger waves now on the negative side and start exclusively looking for triggers on the positive side, okay, up here. And so after you have found that anchor wave, again, you just take note. You're not rushing into a trade. You're not FOMOing in. You're just saying, okay, soon I might have a setup. Then you wait for that trigger wave. Now, here's the thing, guys. People think scalping is like super quick. Yes, the trades themselves are faster trades. You're not holding them for very long at all. Sometimes just a few minutes. Sometimes I hold scalp for hours. Sometimes I've even had a scalp turn into a swing trade. But you're not entering trades all the time. You have to wait. And just to show you how important it is to wait, in hindsight, it looks like things happen very quickly. But in the actual live market, things don't happen as quick as they seem. If we just measure the time between this anchor wave and this trigger wave right here, it's 1 hour and 15 minutes. So just because you see that anchor wave, don't start rushing into trades. Don't start FOMOing long or short. Just wait it out, right? You might have to wait 1 hour and 15 minutes, or even from this trigger wave here to this trigger wave right here, we have to wait 1.5 hours. Okay, so it's very important that when we're using this strategy, we're very calm, we're very collected, we are doing it without emotion. And then once we've identified our anchor and our trigger, then we're going to look for money flow. This is the key, the money flow. What we want to see is, if we see an anchor and a trigger, we want to see the money flow also moving in the direction that we want to trade. And just to clarify the direction that we want to trade, if we see an anchor and a trigger in the negative side, down below with the green dots, we are looking to take a long. And if we see an anchor and a trigger on the positive side with red dots, we are looking to take a short. Now, we are only going to take a long or short if the money flow is also moving in the same direction as the trade we want to take. Okay, let me give you an example. Right here, okay, we can see that we have well, actually, this is not a good example because this is actually the only exception where you would take a trade if the money flow does not agree. But let's see if I can find a trade that we would not have entered. So, okay, so right here, okay, right here, we see that we have an anchor wave right here. And then technically we do have a trigger wave right here as well. But look at the money flow. If we connect the money flow, it's actually getting higher, so we would not take the trade. We would only take trades if the money flow also agrees with the direction that we want to trade in, okay? So a great example would be this right here, okay? This long setup right here, we can see that we do in fact have our anchor right down here, and then we are getting our trigger right here. Look at what the money flow is doing. The money flow, very clearly, if you can take a line and see that as price is coming up to that trigger wave, money flow is getting closer to crossing over the direction you want to trade. That would be the signal to take the trade. Now, let me just clarify a few things before we go on. People often ask, is it okay to skip waves? Yes, it's okay to skip waves. If you have an anchor wave down here, and then we have these two triggers, and you don't get your money flow confirming, well, technically, yeah, you would have actually gotten your money flow confirming here as well, right? Because we can clearly see the money flow is getting higher as we are looking to enter the trade. But if, let's say, you get the anchor wave and then the first trigger wave prints and money flow is not also confirming that you should enter a trade, you can wait for the next trigger wave, and if money flow is confirming on the next trigger wave, it's okay that you skipped over one of those trigger waves. Now, also, let's take a look here at this setup that we got right here, we could see that we have our anchor wave right here. We have our trigger wave right here. And we also see money flow is getting lower. That would have been an entry right there. What would not have been an entry is this. We have our anchor wave right here. We have our trigger wave right here. But look at the money flow. The money flow is getting thicker, right? It's getting thicker as we start to print our trigger wave. So the money flow is going to be the filter that gets us in and out of positions. Money flow is going to be that filter that gets us in and out of positions. So let's go and back test a few of these. But before we back test, I want to talk about where we are going to put our stop loss. Now, trading is something that I recommend everybody continuously work on. And if this is something that you want to perfect, if you actually want to do this full time and have a multiplicity of tools in your toolbox, then check out jasoncaspertrading.com, because this course is my comprehensive trading course. It will give you everything you need to get started. I've had people trading for less than a year who have actually quit their job and started doing this full time just by internalizing the information in this course. Because what we do is we give you a step A to step B process so that you always have a plan in advance. You can have a swing trading plan, a day trading plan, a scalp trading plan, all at the same time. You always know what you're going to look for. You always know where your stop loss, take profits are going to be, how to feel confident in your trades, how to use good risk management so that even if you're not winning every trade, even if you're losing more than you're winning, you can still at least not blow your account. We give you 5 tested strategies, as well as going over how to basically take all emotion out of the trading. There's a 30% discount in the description. You can check that out if you're interested. But for this strategy, the way we are going to set our stop losses and take profits is simply by using a 2-to-1 risk-reward ratio. 2-to-1 risk-reward. Basically, what this means is we are shooting for 2 times more profit than the potential loss we will take if we are stopped out. And the reason why we are using a 2-to-1 risk-reward ratio is because if the win rate is greater than 1/3, okay, in other words, if you're winning more than, let's just say 3 out of 10 trades, then you're going to be profitable using this strategy. And definitely this strategy has a much higher win rate than 33%. Okay, it has a much higher win rate than 33%. It's over 50%. And basically, if you stick to this, you will make money trading this strategy. Okay, we're going to get into the bonus of looking for divergences and also taking partial profits. But for the sake of simplicity, let's quickly go and back test this strategy here. Let's quickly go and back test this strategy right here using simply the 2-to-1 risk reward. I always have trouble saying risk reward ratio. Okay, so let's go back in time and just start over here. Okay, let's just start over here and we will zoom in. I'm going to show you how you're going to do this. So we have ourselves right here an anchor wave right down here, and then we have ourselves a trigger wave right here. Okay, a trigger wave right here. And so what we do is we set our risk to reward ratio 2-to-1. Okay, so if we enter the trade right here on this trigger wave, we would set our stop loss above that last swing high, and we would set our take profits where we can see actually right here, it will give you a risk reward ratio. If this number right here says 2, that is where you would set your take profit. So we could see right down here, this would be our take profit, and that first trade would definitely be a loss. We can see that we would have come down. We would have come down and missed our take profit and then gotten stopped out. Okay, now trade number 2 would have been this right here, this next trigger wave right here. Now this one, we set our risk to reward ratio. We are entering the trade up here, and we are going to place the stop loss above the last swing high. And then really the risk reward that we are shooting for is going to be the 2 to 1, okay? So we would come down here, 2 to 1, and we can see that this trade definitely would have been a win, right? Definitely would have been a win. Now, yeah, the price comes down a little bit lower, but that's okay because we do not care if price is coming down lower. We're just shooting for the 2 to 1 risk reward. Now we have a trigger wave right here. We would not take this trade because the money flow is getting thicker as we come up to that point. So we are not going to take that trade. Then we have this trigger wave. Now notice I'm skipping over all these waves, right? I'm skipping over all these waves, but it's okay because we still have this initial anchor wave up here. And so every consecutive wave that happens counts until we start printing anchors and triggers on the bottom side, right? Until we start printing anchors and triggers on the bottom side. So now we have this trigger wave, and up here we can see very nice entry. Money flow is getting lower as we come. That is confirmation to enter the trade. So we enter the trade, we put our stop loss above that last swing high, and then we would set our take profit down at a 2 to 1 risk reward ratio, which again is another win. So we have 3 trades, we have 2 wins, and we have 1 loss. So we've already made, based on our, we've lost 1 trade, but every win has been twice the amount that we were risking. So we are in profit even after 3 trades, 1 loss, 2 wins, definitely in profit. And of course, the price keeps running from here, but that is okay because we don't really care if price keeps going. This is a scalping strategy. We're entering and we're exiting the trade. We're not really going to leave the trade open. I will go over an exception later. Now we have this anchor wave right here. I'm sorry, trigger wave right here. We had these down here, but we would not have taken those trades because the money flow is getting thicker. And then now the money flow starts to get thinner. And so this would be a confirmation. And for this trade, we can see that clearly this would have been a winner right up here. Okay, so we enter, we put our stop loss above the last swing high. And we have the 2 to 1 ratio, which is coming right down to about here, give or take. And that obviously is a win. Now, look at all the profit we could have been leaving on the table here, right? This trade actually could have been more of like a 20 to 1 risk reward ratio, closer to 30 to 1 risk reward. Okay? So keep that in mind because there is actually a way that I account for that and will keep the trade open to make more money. So let's see what else we have here. We have this trigger wave. Now we can consider this an anchor, even though this was a trigger from this anchor. Because it's over the 60 line, we could still consider this being the trigger of this wave, but being the anchor for consecutive waves. So now we have this entry right here, where we would enter, and because money flow is getting lower, so we would enter on this trigger wave. We would put the stop loss above. I mean, it's a very, very, very tight stop. These are the nice types of trades where we can use very tight stops, and we simply do a 2 to 1 risk reward, which is a winning trade. Okay, now some of these are smaller moves, but if you are limiting out of your position, you can still make a profit on this, right? You can still make a profit limiting out of this position. This is a a 0.6, almost 0.7% move, which for a scalp, guys, is pretty juicy. If you're using higher leverage, you can really make a decent profit on your margin with that. And then we have this trigger as well. Okay, so we've taken 5 trades now. 1 was a loss, 4 were wins. This one right here, we can see money flow is getting lower. When money flow is about to cross over, that's also a potential sign, guys, that you might want to consider holding the trade a little bit longer. I'll get into that in a second. We have this trigger wave right here. And again, 2 to 1 risk reward. Go ahead, stop loss above that high. And we shoot for the 2 to 1, which is right about here. another 0.7% move, give or take. And again, you know, that's a winning trade for us. Now, let's take a look at some longs on the bottom here, right? The longs, what are we looking for? We're looking for money flow coming up. We're looking for an anchor and a trigger, right? So notice that as price is coming down all this way, money flow is also coming down. So we don't take any of those trades, even though we're getting anchor waves here. Even though we're getting a trigger wave right here. The first trigger wave that we would consider would be this one right here, because money flow is clearly coming up, right? Money flow is clearly coming up. Now, because the money flow is coming up, we go ahead, enter the long trade, and we would put the stop loss below the last swing low and shoot for that 2-to-1 risk reward. And where's that 2-to-1? Right about here. Ooh, look at that. Are we gonna? Oh man, we would have just missed that one, right, guys? what a bad Oh wait, no, I'm sorry. It's because my stop loss. Okay, sorry guys. Brain fart boomer moment right there. So this, honestly, you know, this trade right here, it actually would have been a pretty nice win. That's we clearly would have been in profit from this trade, not getting stopped out. So you can see this has a very, very high win rate. And let's see if we can find another. This was not a trigger wave because it was lower than the last one. Oh, and I should say, if there's a big green dot underneath the wave, always consider that an anchor wave, right? And then right here, we have this one's unclear. These are unclear with the money flow. Money flow staying stagnant. We want to see clear direction. This wave right here, money flow is actually getting lower. This wave right here, money flow is also getting lower. Money flow is getting lower. We don't take. We don't take. We don't take it. We don't take it. Money flow is getting higher, even though we have a trigger wave, so we wouldn't have taken that either. So this one we actually would have taken. Oh no, we didn't have a trigger wave there. Was money flow getting higher here? We can see, like, we're not always going to get many trades per day, but the trades we do get are usually going to be pretty good. So we wouldn't have really taken too many trades in this whole area using this strategy. That's why it's important to always have, you know, a multiplicity of strategies. That's why I recommend checking out the course. But yeah, let's see what's going on here. Yeah, so right here actually is a good one. This one, we have money flow getting thicker. We have an anchor over here, and then we have triggers here. So this one, we would enter the long right about here. Let's move this over. And we do the 2-to-1 risk to reward. This is a very, very tight stop, very, very clear stop loss under our last low. And I consider the last low being like the last low put in before that trigger wave, And so this one here, 2-to-1 risk to reward, would have also been a win, just a tiny little scalp, guys. That's the thing. You know, a 0.5% move is still a good scalp, right? Still a good scalp. Let's see. Where would have been our next trade? Honestly, would have been this right here. We have this tight red trigger wave after printing the anchor over here. And this one would have been really nice. We could see money flow clearly coming down. Here. And so we would enter like this, short position right here. And the stop loss goes above that last swing high. And then we do the 2-to-1 risk to reward, which again is a pretty small move. This one might not even be worth taking, honestly. If you have a very, very tight stop loss, you can go ahead and do a 3-to-1 risk reward, honestly, which I do a lot, or even more, especially if you're getting the money flow crossing down. So let's talk about actually how to guarantee a winning trade if, for example, you are noticing that a lot of times these trades are really running, but you're missing the majority of the move. So here's what we can do. We can take partial profits and move the stop loss to entry if things are looking good. So if things continue to look bearish, like you are, coming up to your take profit and you see money flow is still getting lower, and you're like, you know what, I think I could stay in this trade a little bit longer. Instead of gambling it and leaving the whole position open, risking that you could take a loss, what I recommend doing is taking 50 to 70% partial profit. 50 to 70% partial profit, and then leaving the trade open. So in the example of the trade we just took here, if we are coming into the trade like this, okay, and we hit our take profit 1 at the 2-to-1 risk reward ratio, in this case it's only a 0.3% move, okay, what we can do is we can take 50% out of the trade and then set take profits along the way down and move the stop loss to the entry. So what this does now is it's guaranteeing that we hit our take profit 1 right here. We take 50% out of the trade, guaranteeing the trade to be a win. And then as we come down, we are going to take more partial take profits. And the way I set the partial take profits is by looking at areas of support and resistance. So right here, I would say we have an area of support. I might take another 10-15% out of the trade. I would say that also this wick right here, clearly an area of support. If ever you see a low wick like that, say I'm going to look to take these lows, set another 10-15% take profit down here, and then I just go back in time and look for other areas of support or resistance. So I would probably have said, okay, if we're going to take out this wick, then my next take profit will be down here. Okay, whoop. I guess I messed that up, huh? Now, you're not always going to hit every take profit, but that is a great way to taking the 50 to 70% out of your trade. I like 50% after TP1. 50% after TP1 is a great way to, one, not only, because here's the thing, people have the tendency to get FOMO if they take a scalp. They close the whole position in profit, but then price keeps going their way. They have the tendency to then FOMO back into the same position instead of just sitting out. And so a way to avoid that feeling of FOMO is take 50% of the trade out. It's guaranteed a winner. Now your only two options are you're going to have won the trade or you're going to make a lot more money on the trade. So those are the two ways to really set up your take profits. And then we have a bonus here, which is looking for divergences. If you ever see a divergence when you're using this strategy, it's a very good trade setup and you don't have to wait for money flow. What is a divergence? A divergence is where price is doing the opposite of the momentum wave. So if price is making lower lows, but your anchor and trigger is making higher lows, this is a divergence and it's a very powerful move. And I would always, for divergences, shoot for a 3-to-1 risk reward ratio. Also, we can see up here that we have price making a higher high, but the momentum waves are making a lower high. This is a divergence also. Basically, you can think of a divergence as price and momentum doing the opposite thing. This is showing us that although the price is getting lower, momentum is coming into the market, and this is a sign that there needs to be a correction because things are out of balance. Contrast this to an anchor and a trigger where both the price and the momentum are doing the same thing. So if they're both getting lower, that is not a divergence and you need money flow confirmation. If price is getting higher but momentum is getting lower, that's a divergence and you don't need to wait for money flow confirmation. And I always prefer to use the 3-to-1 risk reward ratio when I see a divergence. So guys, this is the strategy. If you found this helpful, make sure to like the video, make sure to subscribe to the channel, and I will see y'all in the next video. Peace.